Hello everyone, welcome to Story Markets. We're going to look at a quick recap of what happened in markets last week. So to start, let's just look at two simple but very important indicators. So here we have the 10-year yield that finished the week 7 basis points lower, while you have stocks were up 0.5%. So this 4.24% yield is what you earn by buying a 10-year US government bond and essentially lending money to the US government for 10 years. And now for stocks, this 5,668 number doesn't say much on its own. So people usually just track whether it moves up or down and by how much. So here's a quick intro of what these mean. So the 10-year yield is a key interest rate benchmark across markets in the economy. And by markets, this impacts all sorts of borrowing costs. So for individuals, think about the interest rate you would get if you were to finance a new Mercedes, or if you were to buy a new Rolex on your credit card. And then for corporations, think about the interest rate a Netflix would get on a loan if it wants to build a new film studio. So if yields go down, that should drag borrowing costs lower with it. And then by the economy, this just means growth and inflation expectations. So when you see falling yields, just remember that tends to be associated with slower growth, lower inflation, or a risk-off appetite. And by risk-off, that just means that the market is favoring safe assets. So the S&P 500 here is a popular stock benchmark for large American companies. So these are capturing the 500 of the largest, most recognizable names like Apple, Amazon, Nvidia, or Tesla. So a rising level here tends to be associated with investor confidence, corporate profitability, or a risk-on appetite. And risk-on here just means that the market is favoring high-risk, high-reward assets like stocks. Okay, so let's dive into the price action here, divided by 5 days of the week going from Monday to Friday. So each day, we start with the Tokyo session, we pass on to London, and then we finish in New York. So on Thursday, Japan had a holiday, so we're missing that session. It was vernal equinox day, so I'm thinking cherry blossom season. So bonds trade round the clock, so you'll see levels throughout. And then I'm only showing US stocks for now, so these will only be appearing in the New York session. Now, if we look at stocks over the whole week, you'll see that each day has its ups and downs. But over the course of the entire week, things were pretty flat. So for this episode, I'm going to skip over stocks and mostly look at bonds that were slightly more interesting. So in yields, we had a 7 basis points fall over the whole week. Monday and Tuesday had ups and downs, but it pretty much finished where it started. Thursday and Friday, same thing. You had ups and downs, but you pretty much finished where you started. But Wednesday is where we want to pay attention, and that's pretty much the whole week's move there in this circled area. So what happened? Well, Wednesday was what we call a Fed day, and that's where the central bank has a meeting. Now that comes with a monetary policy decision, it comes with projections, and there's a press conference with it. So a quick aside on what's this whole Fed stuff. So Jay Powell is the boss. That's what he looks like. They have what's called a dual mandate, which is to maintain price stability and maximum employment. Now these tend to come at the expense of one another, so the Fed's job is to pretty much find a right balance. To do that, their main weapon is the power to set short-term interest rates. Now don't get confused, the Fed's interest rate is something else, and it's not the 10-year interest rate that we're seeing on the screen. So when the Fed hikes interest rates, that's designed to bring down prices while slowing the economy. And now on the other hand, when the Fed cuts interest rates, that's designed to boost the economy, but at the risk of higher prices. So at this Fed meeting, there was no action taken. So they didn't hike, they didn't cut, all they did was kept rates the same. So everything was about the projections and the press conference. So the consensus takeaway was dovish, and that's just market speak for more likely to set rates lower. Here's what we got. So number one, growth projections got cut, and number two, inflation expectations got raised. Now this one got downplayed because Powell used the word transitory, or what he means is temporary due to Trump tariffs. So you can kind of pretty much ignore this portion for now. So let's go back and focus on point number one. Cutting growth projections can be interpreted as an uh-oh. So if the Fed is signaling that, one can simply argue that to deal with it, they're more likely to set interest rates lower. And then just to remember, rate cuts are designed to boost the economy. And very simply, that's how the markets reacted when you see rates falling on Wednesday in that circled part of the graph. So if there's new info coming in that rates are expected to be lower, then that's going to move markets to trade in that direction. So that's the week. There you have it. Thank you for tuning in. Please like and subscribe if you found this helpful, and please leave a comment if there are any concepts you'd like me to explain further, and I might do a dedicated video for that. Thank you.